You open your first brokerage account on a Tuesday, and by Friday, you have read enough to know exactly one thing for certain, which is that index funds are the answer. Every article says it. Every video says it. Low fees, broad diversification, historical returns averaging 10% per year. Just buy and hold, and let time do the work. You transfer $500. You buy a total market index fund. You feel something close to pride. The specific pride of someone who has finally figured out the thing that took everyone else decades to figure out, except you figured it out from a podcast on the way to work. You set up an automatic contribution, $200 a month. You feel like you have solved adulthood. The fund goes up 2% in the first month. You check it 4 times that week. You did not know you would check it 4 times that week. Nobody mentioned that part. 2 months later, the market drops 8% in a single week over some headline you don't fully understand. Something about rates, something about inflation, something that sounds urgent on every channel at once. You watch your $1,400 become $1,288. You do not sell. You feel proud of not selling. You tell a friend you didn't sell, and your friend nods, like this is normal, like everyone does this, like staying calm during a drop is the bare minimum and not actually the hardest part of the entire exercise. You do not yet know that this moment, this exact moment, this 8% drop on month 3 is the first of dozens of tests you will face over the next 30 years, and that your performance on these tests, not your fund selection, not your expense ratio, not your asset allocation, is going to determine almost everything. You do not know this yet. The fund recovers in 6 weeks. You feel vindicated. You think the hard part is over. The hard part has not started. Level 2, the believer. You are 2 years in now. $200 a month has become $350 a month because you got a raise and decided to increase your contribution, which every article says is exactly what you're supposed to do. Your portfolio is at $11,200. You have read more now. You know what an expense ratio is. You know your fund charges 0.04%, which you have learned to say with the slight superiority of someone who knows other funds charge 0.75%, and feel sorry for those people without entirely understanding why. You have not yet learned about the other fees, the ones that don't show up on the funds page. The advisory fee on the robo-advisor app you started using because it looked clean and had nice graphs. The 0.5% that gets quietly debited and that you have never once looked at as an annual dollar figure, because annual dollar figures are not how the app displays it. You have also started keeping about 15% of your account in cash. Not on purpose exactly, more because contributions. You have also started keeping about 15% of your account in cash. Not on purpose exactly, more because contributions land and you don't always move them into the fund right away. And that 15% has been sitting there for 14 months, not doing anything. And you have never calculated what that's costing you, because cash sitting still doesn't feel like a cost. It feels like safety. The market has a good year, up 18%. You feel like a genius. Your portfolio crosses $18,000. You start telling people that investing is actually simple, that everyone overcomplicates it, that you just buy index funds and don't think about it. And you genuinely believe this. And you are correct about the buying part and incorrect about the not thinking about it part, because you are thinking about it constantly. You just don't recognize the thinking as thinking because it doesn't feel like effort. It feels like checking. Checking is not free. Checking is where this entire thing starts to go wrong for almost everyone. And you will not understand that for years. The test. 5 years in, your portfolio is $58,000. You're contributing $400 a month now, then the market drops. Not 8% over a week, 34% over 4 months. The kind of drop that has a name within days, that gets its own segment on every financial show, that your parents call you about, that your coworkers talk about at lunch, with the specific tone people use when they're scared but performing calm. Your $58,000 becomes $38,000 in 4 months. You watch $20,000 disappear, and it doesn't feel like a number going down on a screen. It feels like something being taken from you, even though nothing has actually been taken, even though you haven't sold anything, even though on paper, this is exactly the scenario every single article told you to expect and to ignore. Every article is suddenly very far away. Every calm statistic about long-term average returns is suddenly competing with the very loud, very immediate, very real feeling of watching 5 years of contributions get cut by a third, while the news plays footage of trading floors and uses words like unprecedented. You stop your contribution that month. Just that month, you tell yourself. Just until things stabilize. You don't sell anything. You just stop adding. The market keeps falling for 6 more weeks. Then it stops falling. Then, over the following 8 months, it recovers almost all of it. You restart your contributions in month 4 of the recovery, 2 months after you paused, which means you missed 2 months of buying at the lowest prices the market offered in your entire investing life so far. You don't calculate what that cost you. Nobody calculates what that costs them. This is level 3. This is the test almost everyone fails at least partially, and almost nobody fails completely, which is exactly why almost nobody notices they failed it. You didn't panic sell. You're not in the headlines about people who lost everything. You just paused for 2 months during the exact 2 months that mattered most. And then you resumed, and your portfolio kept growing. And from the outside, and even from the inside, it looks like nothing went wrong. Level 4, the audit. 12 years in. Your portfolio is $187,000. Decent. You feel decent about it. Then you do something almost nobody does, which is you actually sit down and calculate your real return. Not the fund's return, your return. The number you actually captured after the cash drag. After the robo-advisor fee you never looked at as a dollar figure. After the 2-month pause in year 5. After a similar 3-month pause in year 8 during a different scary headline. After the slightly too conservative bond allocation you added. After the year 5 crash, because you wanted to feel safer and never adjusted back. Your fund averaged 9.4% annualized over these 12 years. Your actual return was 6.1%. That gap, 3.3 percentage points per year, compounded. Over 12 years, on contributions that grew from $200 to $400 to $550 a month as your income increased. Comes out to a difference of $61,000. $61,000 that exists in the version of your life where thou didn't pause twice, didn't carry idle cash, and didn't pay an advisory fee thou forgot thou were paying. Thou stare at this number for a long time. Thou art not angry exactly. Thou did everything the articles told thee to do. Thou picked a low-fee fund. Thou diversified. Thou didn't panic sell during either crash. By every measure anyone gave thee, thou did it right. And thou art still $61,000 behind where the math says thou should be. And the math doth not care that thou feel like thou did it right, because the math was never measuring effort or intention. It was measuring execution. And execution, it turns out, has dozens of small leaks that none of the beginner articles mention, because the beginner articles are trying to get thee to start. Simple. And it is simple, and that's exactly the problem. Because simple things that are also fragile don't look fragile until you've been doing them imperfectly for over a decade. Level 5, the long run. 30 years in, you're 57 now. Your portfolio is $1.4 million. By any reasonable measure, this worked. Index fund investing, for you over 3 decades, built real wealth. The kind of number that changes what your 60s look like. The kind of number your 25-year-old self would not have believed and would have been thrilled by. But you also know something your 25-year-old self didn't, which is the other number. The one that sits next to $1.4 million in a spreadsheet you made one weekend out of curiosity. The number your portfolio would be if you had captured the market's actual average return instead of your real return. That number is $2.1 million. The gap is $700,000. $700,000 accumulated not through one catastrophic mistake, not through some scandal, or scam, or bad fund, but through 3 decades of small, invisible, individually defensible decisions. 2 months paused here. 3 months paused there. An advisory fee you stopped questioning because it was automatic. Cash sitting idle during your highest income years because moving it felt like a task for later. A slightly too conservative shift after a crash that you meant to undo and never did. None of these decisions in isolation would alarm anyone. Each one, examined individually, sounds like the behavior of someone being prudent, being human, being reasonable in the moment. And that's the part nobody tells you when they tell you index funds are simple. They are simple. The math is simple. The instrument is simple. What's not simple is being the kind of person who executes a simple plan with 0 deviations for 30 consecutive years while markets crash twice, while fees quietly compound in the background, while cash sits idle during the exact years when time matters most, while your own emotions, which are not a bug in the system, but the central feature of being a person, push you toward dozens of small decisions that each cost almost nothing, and together cost you $700,000. The fund did its job. The market did its job. The 10% was there the entire time, available, real, sitting in the index for anyone who could capture all of it. Almost nobody captures all of it. Not because the strategy failed, because the strategy was never the hard part. You were.